Okay, so the question we're going to ask now is what will cause the exchange rate to change? So if we have a certain exchange rate now, what's going to cause it to change? All right, so let's go ahead and look at this using our supply and demand graphs. So we'll go through several. So one is this expectations. So the exchange rate market is one of those where there's a lot of people just speculating in the market, and those people are just trying to make money off the movements that happen in this market, and so they're always trying to guess. And sometimes there'll be some information that gives them an idea that something's going to happen. Okay, so let's suppose we'll start in the market for RMB. Okay, we're going to go in this RMB market, and for right now, we're pretending that these markets are all just free markets with no government regulation. In reality, some of them aren't, as we'll find out near the end of this chapter. Okay, so that will turn out a little bit differently, but for now, you can just think of them as free markets. Okay. Okay, so we're in this market for RMB, and we're in this situation, and then something's going to change. Okay, so what's going to change is the expectation about the future. So let's suppose there's some report that comes out that's negative about the Chinese economy, and suppose this report predicts that the exchange rate is going to change. So people expect the RMB to weaken against the dollar in the future, okay, against the dollar. So there's an article that says, they expect over the next 6 months or 2 years, the RMB is expected to weaken, and a lot of people believe this. So what's going to happen to this market? So what's going to happen to this market is going to actually be two changes. Because remember, the demand is people who want to buy RMB. Well, if you hear that the exchange rate is going to weaken, that it's going to get weaker, so that means each RMB is going to be less valuable in terms of other currencies, you don't want to buy it, right? So this is going to reduce demand. So because they think it's going to get weaker, they don't want to buy. They don't want it, right? So less people want to buy because they think it's getting weaker. And there's also going to be an increase in supply. Well, let me first show the first one. Okay, so a decrease in demand will be shown this way. Right, we got our decrease in demand, and we're also going to get an increase in supply. People that hold RMB want to get rid of it. So people holding RMB want to get rid of it. Okay, they want to get rid of it. So we'll get this idea. So that will increase supply. So they're trying to dump their RMB. And so we end up at a new equilibrium. So before we were up here, right, whatever this was. So this was maybe, what we had before, this was, let's see, 15 cents. And then now we might be here at, this would be really extreme. Okay, this is not very realistic. But maybe we're here at 10 cents. Okay, so what happened? Well, our final result, so now the RMB is weaker. So the RMB, this is really extreme. I drew it really extreme just to kind of make it obvious for you, but this would be unlikely to happen in the real world unless something really major happened. It would happen, just not this big. So the RMB weakened against the dollar. So, right, now only need 10 cents to buy 1 RMB. Conversely, you could also say that the US dollar has strengthened against the RMB, right? So you could also say US dollar is stronger. Now $1 buys 10 RMB. Okay, so again, the degree of this movement is kind of unrealistically big, unless it was a major disaster. But you get the basic idea. When people expectations change, so if they expect it to weaken, it sort of will weaken. Now, I'm not going to draw it in this, but what could also happen is it's also possible that this weakening causes further weakening. So if there's a lot of movement, then people will believe the rumor's true, and then more people will try to get rid of this currency, and then it will happen a little bit more. So this can kind of set up a chain of events. They discuss this chain of events in the textbook. Related to Mexico. So go ahead and check that out if you'd like to. But you get the basic idea We get this weakening of the currency because of expectation. The same thing would have happened if we had looked at strengthening of the currency. If we had thought people expected to strengthen, then they'll want to buy now, and people won't want to get rid of it. They want to hold it. So the supply would decrease, demand would increase, and we'd end up with a more valuable currency, a stronger currency. Okay. So let's wait till the next video before we go to the next issue.